Welcome to the Deep Dive. We're your shortcut to understanding the latest earnings calls. Today, we are getting right into the heart of IHI Corporation's first quarter for fiscal year 2025. The results, the strategies, all of it. Our mission, like always, is simple: cut through the noise, give you the essential insights fast so you really get what's going on.
That's right. And with IHI, well, the Q1 numbers for FY 2025 definitely landed a bit softer than many were hoping for. It's really one of those situations where you need to look past the headline figures to understand the bigger picture.
Okay, perfect setup. So let's jump straight into that immediate snapshot. IHI's revenue for the quarter: $337.7 billion. Now that missed the consensus estimates, and it's actually down 3% compared to last year. And profitability, oof. GAAP EPS came in at 76.64. That's way below expectations of 36% miss. That's quite a dip. Operating profit was $20.8 billion, EBITDA at $38.9 billion. So yeah, some clear declines right off the bat.
Yeah, clear declines in profit and revenue.
Yeah.
But it's not all negative. The really interesting part, orders received, despite the other numbers, orders came in strong at $424.3 billion. That's a pretty substantial jump from last year.
Strong orders. Where did that come from?
Mostly driven by good demand in carbon solutions and civil aero engines. So future pipeline looks healthier. On the other hand, cash flow from operations was negative $17.8 billion.
Negative. Why was that?
Mainly down to higher tax payments this quarter. That happened even though they actually made some improvements in working capital across the group.
And the market reaction? Predictably cautious, I imagine?
Pretty much. We saw the share price dip maybe 2.3% right after the announcement.
Yeah.
Definitely reflects some investor unease,
Yeah, you see numbers like that Q1 EPS miss, and it makes you pause, which makes it all the more interesting that management is sticking to their full-year outlook, right?
Exactly. That's a really key point here. Despite that soft Q1, they've emphatically maintained their full-year FY 2025 guidance. They're basically signaling a strong belief in a second-half recovery. It shows, well, a lot of confidence in their plans.
It does seem bold, sticking to guidance after a miss like that.
It is. It suggests they either have a very solid strategy lined up, or perhaps their initial forecast had quite a bit of cushion built in. Either way, it's something to watch closely.
Okay, let's unpack this then. Why did Q1 come in softer? And, what's really fueling this confidence for the second half, especially after that start?
Well, the main drag on Q1 performance wasn't necessarily like a sudden downturn in business. It was more about timing and project mix. Specifically, the absence of some really large projects that boosted results in the same quarter last year that hit revenue and profit across a few segments.
So a tough comparison year over year because of those large projects finishing up.
Precisely. Also, the yen appreciated, which had a negative impact on the profit attributable to the parent company. But it's important to remember that was mostly a translation effect on paper. Didn't really hurt cash flow much.
Okay, so project timing and FX. What about the confidence going forward?
A huge part of it hinges on improvements they expect from Q2 onwards. They're pointing specifically to nuclear cost recovery.
Nuclear cost recovery. Can you explain that a bit?
Sure. It essentially means they expect to get reimbursed for or recognize profits previously deferred on their big long-term nuclear energy projects. As these projects hit certain milestones or get approvals, the financials should reflect that.
Got it. So recognizing value from work already in progress.
Exactly. And beyond that, they're counting on the benefits from ongoing structural reforms they're implementing across the company. What's really telling is that their full-year outlook already factors in about $20 billion in negative impact from U.S. tariffs and other restructuring costs.
So they've already baked in some significant headwinds.
Seems that way. It suggests they feel they have solid plans to manage those challenges rather than being surprised by them later.
Okay, this is where it gets really interesting. Let's break down the individual business segments, see where the strengths and weaknesses are, and maybe spot those strategic shifts more clearly. It's definitely not one single story across the board.
Absolutely not. And looking at the segments really clarifies things. Take aero engine, space, and defense. That was a clear winner this quarter. It saw year-on-year growth in both revenue and profit.
What drove that?
Strong performance in the defense side of things, plus steady expansion in civil aero engines. Particularly spare parts sales for models like the B2500 engine were up a solid 20% year over year.
20% on spares, that's quite healthy. That's a high-margin business too, right?
Generally, yes. So that's a really positive sign and a key area to watch.
Okay, so aero and defense looking good. What about resources, energy, and environment? That's where the nuclear piece sits, right?
It is. And that segment saw revenue decline. Again, largely due to those missing large projects from last year, but also some weaker performance at overseas Carbon Solutions subsidiaries. Operating profit took a temporary hit because they recognized some costs up front for domestic nuclear projects.
Ah, the cost came before the recovery you mentioned earlier.
Exactly. Management is very clear they expect improvement here starting in Q2 as that cost recovery kicks in. They're also doing some significant restructuring at their U.S. subsidiaries in this area, focusing on higher margin work, cutting back the workforce a bit to lower fixed costs, trying to make it leaner.
Right, makes sense. How about social infrastructure?
Similar story on the top line, declines because of the absence of large prior year projects. But strategically, there are big moves here. They announced plans to merge two subsidiaries, IHI Infrastructure System and IHI Infrastructure Construction, by November 1st.
Merging them. Why?
The goal is to really focus on domestic bridge maintenance. Japan's got a lot of aging infrastructure, so they see long-term growth potential there. They also decided to sell off their transportation systems business to JOL Partners Group, another move to streamline.
Okay, focusing on bridges, divesting transport, and the last one, industrial systems and general purpose machinery.
That segment saw a slight revenue dip, but interestingly, profitability in their vehicular turbocharger business actually got better.
Better? How?
They managed to get better sales pricing, plus they cut fixed costs. It seems they're managing that business quite effectively. And the impact from tariffs on those turbochargers, minimal in Q1. They've even managed to get agreements with some customers to share the burden of those tariffs.
Proactive management there. So stepping back from the segments, what's the big picture strategy that emerges from all these moving parts? It feels like a lot of deliberate reshaping.
Oh, definitely. You're seeing a clear push towards pretty significant portfolio streamlining. They didn't just sell the transport business. They also resolved to divest Niigata Transease and Meizai Electric. Plus, they already did that partial share transfer of Japan Marine United back in June.
So several divestments.
Right. These aren't just random sales. It fits a pattern, a strategy focused on shifting towards their higher return core businesses. Think aero engines and defense again. It's all about capital recycling, taking money out of less strategic or lower return assets and plowing it back into growth areas or strengthening the balance sheet.
A classic conglomerate refocusing strategy, really, trying to get leaner, more focused.
Exactly. Making the company more agile, focusing on where they think they can win globally. It's about crafting that clearer, more focused growth narrative.
Okay, let's shift perspective a bit. Thinking longer term, beyond just these quarterly numbers, what are the key factors, the broader trends, maybe the catalysts investors should really keep an eye on with IHI?
Well, one major factor we've touched on is the U.S. tariffs. That remains a key uncertainty. As we said, they've baked in an odd $20 billion hit to operating profit in their forecast. They are actively working on mitigation.
Like shipping parts differently to avoid the U.S.?
Yeah, things like shipping new engine parts directly to assembly plants overseas, bypassing U.S. transit where possible, plus ongoing internal cost cutting. But how effectively they manage this whole tariff situation will be a critical performance indicator going forward. It's definitely something to watch.
Okay, tariffs are a big one. What's the general feeling or sentiment around IHI right now, given the Q1 miss but the maintained guidance?
I'd say it's cautiously neutral, leaning perhaps slightly cautious. The market is definitely discounting some near-term risks, particularly around execution in that resources, energy, and environment segment, getting that nuclear recovery sorted, and, of course, the tariff uncertainty. But that's balanced against the positive long-term story, especially around aerospace and defense. Management's narrative is that Q1 was noisy due to timing and mix, and the second half will be much stronger.
Are there broader tailwinds supporting them?
Potentially. Things like the overall 2-tick-6 machinery cycle in Japan have been pretty robust, which suggests general industrial strength. And, rising global defense spending certainly doesn't hurt their defense segment.
So what are the specific catalysts then? What should we look for in the coming quarters to see if management's confidence is, well, justified?
Okay, key checkpoints. First, the Q2 and Q3 results. That's when we need to see hard evidence of that nuclear cost recovery starting to come through and get a clear picture of the actual tariff impact versus the forecast.
Right, proof points.
Second, keep an eye on those aero spare parts sales. They were strong in Q1. We need to see if that throughput continues relative to their plan. It's a crucial profit driver. Third, watch for the closing of those announced divestitures, Niigata Transease, Meizai Electric. Any further portfolio moves would also be significant signals of strategic focus.
And anything else?
Well, towards the end of the fiscal year, Q4, you've got the mechanics of the dividend payment, and importantly, that stock split actually happening that could influence investor sentiment and stock liquidity.
Okay, that brings up shareholder returns directly. You mentioned the stock split. What are the details there?
It's a pretty significant one. IHI announced a 7-for-1 stock split. It's set to become effective on October 1st, 2025, with the record date being September 30th.
7 for 1. The main goal there is usually
Primarily to make the shares more accessible to a wider range of investors by lowering the price per share. It aims to broaden ownership, improve trading liquidity. They also mentioned a revision to the year-end dividend forecast, but they kind of downplayed it, saying it was nominal, not really a substantial change in the actual payout amount. The split is the big news on the mechanics front.
All right. Now, as we start to wrap up our deep dive on IHI, it's time for our This Is Not Financial Advice segment. Always speculative, but hopefully plausibly so. Based on everything we've just unpacked, what's a, let's say, wild but plausible trade idea you might be mulling over?
Okay, sticking strictly to the not financial advice disclaimer, but considering IHI's situation, the maintained guidance despite Q1, that big 7-for-1 split coming up, and this aggressive pruning towards higher margin aero defense, you could hypothetically think about a longer-term option strategy, maybe something like a laddered call option spread.
Okay, break that down. What's the thinking?
Well, you'd be betting on significant upside, but maybe not until after Q2 or Q3, once those nuclear cost recovery points are clearer and the split is done. So you might buy a call option that's slightly out of the money, expiring sometime after those key checkpoints and the split. At the same time, you'd sell a further out of the money call with the same expiry date.
Selling the further out call reduces the cost of buying the first one, right? But it caps your potential profit.
Exactly. It makes the trade cheaper to put on, offering limited but still potentially significant upside if the market really starts to believe in that second half recovery and the whole cleaner aero defense growth story that management is pushing. Plus, that stock split could generate more retail interest and improve liquidity post-split, which might help the stock price action needed for the options play. It's definitely a bet on management executing well in the coming quarters.
Interesting idea. A structured bet on that second half recovery narrative taking hold, amplified potentially by the stock split. Okay, so let's quickly summarize then. IHI's Q1 financials missed expectations, yes, but offset by really strong orders. Management sticking firmly to full-year guidance, banking on a second-half rebound. All this is happening while they're actively streamlining the business, selling off units, focusing on core areas, and bringing in shareholder-friendly mechanics like that big 7-for-1 stock split. A real mix.
Absolutely. The key, as we've said, is going to be execution. Delivering on those nuclear project cost recoveries, successfully managing the tariff impacts, and keeping that momentum going in the aerospace parts business. Those are really the catalysts that will determine if the narrative shifts fully positive and if they hit that confident guidance.
So a final thought for you listening. What stands out to you from IHI's plan? Is it the aero strength, the nuclear recovery bet, the divestments? Which move do you think carries the most weight for their future? Definitely something to think about as you track the company's progress. Thanks for joining us on this deep dive.